Welcome to the high-stakes world of commercial real estate, where the quest for passive income often leads to a single three-letter acronym known as NNN, or the triple net lease. In 2026, the landscape of investing has become increasingly volatile, but triple net properties remain the bedrock of many institutional and private portfolios due to their unique structure and hands-off nature. If you are looking for a way to grow your wealth without the headaches of traditional property management, you have come to the right place, because today we are diving deep into everything you need to know about NNN investing. At its core, a triple net lease is a credit gold mine, where the relationship between the landlord and the tenant is flipped on its head. In a standard residential gross lease, the landlord is responsible for almost everything from fixing the roof to paying the property taxes. But in the world of triple net, the tenant takes on the three major operational expenses, which are property taxes and building insurance and common area maintenance. This means that as an owner, your primary job is to collect a rent check, while the tenant manages the day-to-day realities of the building. For many investors, this is the closest thing to a mailbox money dream that exists in the physical world. As we navigate the economic environment of 2026, it is important to understand why these properties are so highly valued by sophisticated investors. The primary draw is the predictability of cash flow, because these leases are typically signed for very long durations, often spanning 10 and 15 or even 25 years. When you buy a property leased to a blue-chip tenant like a national pharmacy or a major fast food chain, you are essentially buying a long-term contract backed by a corporation with a multi-billion-dollar balance sheet. This provides a level of security that is hard to find in the stock market or in multi-family residential units, where tenants can move out every 12 months. In the current market, we are seeing a significant shift in which industries are considered safe bets for investments. While traditional retail has faced challenges from e-commerce, the triple net market in 2026 is dominated by recession-proof and internet-resistant sectors such as medical services and quick-service restaurants and automotive repair centers. When you are evaluating a potential deal, the most important factor is not the building itself, but the creditworthiness of the tenant standing behind the lease. You are essentially acting as a lender, and the property is your collateral. If the tenant is a massive corporation with an investment-grade credit rating, the risk of default is incredibly low, which is why these properties often trade at lower cap rates. The cap rate, or capitalization rate, is the return on investment you can expect if you paid all cash for the property, and in 2026 we are seeing cap rates stabilize as investors seek safety over high-octane growth. You might find a McDonald's or a Walgreens trading at a 5% cap rate, while a local franchisee might offer a 7 or 8% return to compensate for the higher risk. Understanding this risk-to-reward ratio is the key to building a balanced commercial portfolio. Another critical component of investing is the lease structure itself, particularly the rent escalations. In an era where inflation is always a concern, you want to look for leases that include periodic rent bumps, which are usually every 5 years. These increases ensure that your income keeps pace with the cost of living, and that the value of your asset continues to grow over time. In 2026, many investors are also looking closely at the residual value of the real estate. You must ask yourself, what happens if the tenant decides not to renew their lease in 15 years? If the property is located on a prime corner with high traffic counts and great visibility, you can easily re-tenant the building or even scrape the site and build something new. However, if the property is in a declining area or has a specialized layout that is hard to repurpose, you could find yourself with a dark store that is difficult to fill. Tax advantages are another huge reason why people are flocking to properties this year. Through the use of depreciation and interest deductions, you can often shield a significant portion of your rental income from the eyes of the Internal Revenue Service. Furthermore, the 1031 exchange remains a powerful tool in 2026, allowing you to sell a different piece of real estate and reinvest the proceeds into a triple net property without paying immediate capital gains taxes. This allows investors to trade up from high-maintenance properties like apartment buildings into low-maintenance assets while keeping their wealth compounding in a tax-deferred environment. However, no investment is without risk, and in the triple net world, the biggest threat is vacancy, because most NNN properties are single-tenant buildings. If the tenant leaves, your occupancy goes from 100% to 0% overnight. This is why the location and the strength of the lease are so vital. You must also be aware of the interest rate environment, because as rates fluctuate, the value of your fixed income stream can change. In 2026, we have seen that investors who locked in long-term financing during lower rate periods are sitting on gold mines, while those with floating rate debt are feeling the squeeze. It is always wise to have a long-term perspective and a healthy cash reserve to handle any potential transition periods between tenants. As we look toward the future of commercial real estate, the NNN sector is currently one of the hottest areas for growth. With an aging population and the decentralization of healthcare, more people are visiting urgent care centers and dialysis clinics in retail settings rather than going to large hospitals. These tenants are incredibly stable because they invest heavily in their own build-outs and are very unlikely to move once they are established in a community. Similarly, the convenience store and gas station sector is evolving with the rise of electric vehicles, and many properties are now incorporating high-speed charging stations to stay relevant in the 2026 economy. In conclusion, investing in triple net lease properties is about buying time as much as it is about buying real estate. It is a strategy for those who have moved past the stage of wanting to manage people and toilets and instead want to manage their wealth with precision and predictability. By focusing on high-quality tenants in prime locations with strong lease terms, you can create a portfolio that provides steady income for decades to come. As you move forward with your investment journey, always perform your due diligence and consult with experts who understand the nuances of the commercial market. Thank you for watching this comprehensive guide to investing in 2026, and we wish you the best of luck in finding your next great property.